Hi, once again you're welcome to FTGFx. FTGFx is the short form of Forex trading in Ghana. Now in today's video, we are going to share with you 3 factors that can affect your risk exposure when trading. Okay, so have you ever had trouble telling when you should cut your losses? I know almost every trader has had that or has had that encounter before. Okay, you might have experienced the market going against your trade, and then suddenly you are praying to your trading gods that price would return. Okay, so for instance, if you have a buy order and then the market is selling, okay, you would be praying to your gods or your trading gods to turn the market, or it should go in your direction or where you predicted that it was going to go. Okay, then when you or your accounts have reached your pain threshold, you then end up closing at the top. Okay, so sometimes you cannot sustain the pain or the trauma for very long time. So sometimes it's going the opposite way. You decide to hold it for some time, and then later you close it. Okay, or sometimes you can decide to also not close it at all, and that's when you get your account blown. Okay, now it also tells us one thing, or one important thing, and that is your risk exposure is bigger than your risk tolerance. Okay, so if you begin to panic after a trade, hey, I need to close it, I need to do all of those, emotional kind of thing, then that should tell you that your risk exposure is bigger than your risk tolerance. So in this video, like I said earlier on, we're going to share with you 3 factors that can affect your risk exposure when trading. So the first one we are going to look at is your position size. So your position size is the same as your lot size. Okay, so if you have a smaller account, you need to ensure, whether smaller or bigger account, you need to ensure that the lot size that you are going to choose for your trade is better, or is not going to get you emotionally attached to the trade, that even when there's a little pullback is going to affect your way of trading. Okay, so for instance, if you have $1,000 account and you decide to go with a lot size of say 1.00, it's equivalent to $100. What that means is your lot size alone is 10% of your capital. That should tell you that you are risking a lot. But practically, if you want to have a peace of mind, you can go a lot size of 0.01, which is equivalent to $1. So if you have $1,000, your lot size is $1. It just tells you that your risk exposure is minimal, okay, as compared to somebody who has $1,000 and has a lot size of $100 in there. Okay, so your position sizing or your lot sizing can affect your risk exposure. The second one is holding period. So someone can choose to hold a trade for a short time or longer time. It depends on the trading style. So if the person is a scalper, the person would want to do that within minutes, hold the trade within minutes. If the person is a swing trader, would want to hold it for days, weeks. Position trader would also want to hold it for let's say months, okay, or even years. Now remember that if you have your holding period is directly tied to your balance or your capital. If you have $10, okay, and you as your trading capital, and you decide to hold it for a very long time, remember that you are going to expose the market or expose your capital to the volatilities in the market, the spikes and all of that. And the question is, can your $10 hold, or can it withstand all of this volatility? No. So for instance, if you're a scalper, you can have maybe $10, place your trade, move out of the trade quick or as soon as possible. If you had maybe $1,000 and you have a lot size of 0.01, you can decide to hold it for years, and you have confidence that it will take a very long time before even your account should get blown, it will get blown. Okay, so your holding period also affects your risk exposure. Then the last one we are going to look at is your stop loss. Okay, you need to ensure that you have stop loss in check. Okay, before you even place your trade, you need to know, because most of traders what basically do is the entry levels or the entry triggers. Traders look out for when to enter the market, but as to when to exit becomes a problem. So the stop loss is going to help you, or is going to be your guide or automatic stop that's going to take you out of the market when you are wrong. Don't get it wrong. Stop losses only tells you that you are, or the place you trade, the market hasn't accepted it. Okay, it's not about being wrong or being right, but it just tells you that the strategy at that point in time, the market did not accept that. So all of this, if you decide to widen your stop loss, remember that if you have $10, your lot size is 0.01, which is equivalent to $1. and then your stop loss is around 10 pips. Okay, remember that by the time the market hits your stop loss, your account will be totally blown. Okay, but if you have $1,000, a lot size of 0.01 equivalent to $1, your stop loss as 10 pips. Okay, even if you are stopped out, you still have lots of money in there to trade. Okay, so basically for the three factors that we shared with you, or basically what we wanted to share with you, is three key factors that affect your risk exposure. And we spoke about your position sizing. Your position sizing or your lot sizing should be tied to your the amount you're ready to lose in case the trade doesn't go your way, and then your capital. And then the second one too is your holding period. Is your fund, do you have enough funds to hold your trades for a very long time before it comes your way if there are pullbacks? And then the third one is a stop loss. Your stop loss should also be tied to your balance. Okay, yes, basically these three are the ones that we decided to share with you today. If you want to learn more about forex trading, how to trade the forex market easily, safely and profitably, just send us a DM on Instagram at FTG_FX, and we are ready to help you out. Bye bye.